Welcome to an in-depth video where we will explore the Federal Reserve, its history, the significance of its interest rate policies, and their far-reaching impacts on the economy and financial markets. If you're an experienced investor, or simply looking to deepen your understanding of economics and its mechanisms, this video is for you. We will trace the role of the Fed from its founding to the present day, focusing on the mechanisms of the yield curve and analyzing historical interest rate cut cycles. We'll also examine how rate cuts affect different market phases and how long it has historically taken for markets to stabilize after these decisions. Finally, we'll provide practical tips for investors in a low interest rate environment. Sit back and let's dive deep into this complex but fascinating world together. 1. The founding of the Federal Reserve and its historical significance. To understand the importance of the Fed's interest rate policy, we must first look at its origins. The Federal Reserve, or Fed, was established in 1913 in response to a series of severe financial crises that had shaken confidence in the American banking system. One of the most influential crises was the Panic of 1907, where the stock market collapsed dramatically and many banks failed. Before the Fed's creation, the U.S. had no central banking system. The economy suffered from recurring boom and bust cycles, and there was no central authority to intervene during crises. As a result, the U.S. was one of the last major industrialized nations to establish a central banking system. The Fed was founded to achieve several key objectives: controlling the money supply and interest rates, stabilizing the economy, and overseeing and regulating banks. These goals were designed to reduce the frequency and severity of financial crises and promote more stable economic growth. Over the years, the Fed has evolved its role in the economy. From its early decades as a lender of last resort, it has grown into an institution that actively steers monetary policy and exerts significant influence on the global economy. The Fed's decisions impact not only the U.S. economy, but also global financial markets. 2. The structure and functioning of the Fed. To understand how the Fed operates and why its decisions are so important, let's take a look at its structure. The Federal Reserve consists of several key components. At the center is the Board of Governors, made up of 7 members appointed by the President of the United States and confirmed by the Senate. These members serve 14-year terms, providing them with a degree of independence from day-to-day politics. The board makes the fundamental decisions about monetary policy and oversees the work of the 12 regional Federal Reserve banks. The Federal Open Market Committee, or FOMC, is the most important decision-making body of the Fed regarding monetary policy. This committee comprises members of the Board of Governors and the presidents of the regional Federal Reserve banks. It meets regularly to decide on interest rate policy, particularly the federal funds rate, which is the interest rate at which banks lend money to each other overnight. The FOMC's decisions directly affect borrowing costs, corporate investment decisions, and consumer behavior. By raising or lowering interest rates, the Fed tries to control inflation, promote economic growth, or counteract a recession. Another key player in the Fed is the chair, often seen as the face of the Fed. The chair leads FOMC meetings, communicates the Fed's monetary policy to the public, and plays a crucial role in shaping the Fed's strategic direction. This structure gives the Fed a unique position in the economy. It is independent enough to make decisions that are in the long-term interest of the economy, but also embedded in a system of democratic oversight. 3. The yield curve, a key indicator for investors. The yield curve is a central tool that investors use to assess future economic developments. The comparison between the yields of 10-year and 2-year Treasury bonds is particularly important. Under normal circumstances, the yield curve slopes upward, meaning long-term bonds yield higher returns than short-term ones. This reflects expectations that economic growth will continue and that higher interest rates will be needed in the future to combat inflation and risks. A flat yield curve, where short and long-term bond yields are close together, signals uncertainty in the market. Investors are unsure how the economy will develop and expect growth to slow. An inverted yield curve, where short-term bond yields are higher than long-term ones, is particularly concerning. Historically, an inverted yield curve has been a strong indicator of an impending recession. Investors expect the Fed to lower interest rates in the future to support the economy, indicating weaker economic growth and rising risks. Looking at the last few decades, we see that an inverted yield curve often preceded severe economic downturns. For example, this was the case before the recession in the early 1980s, the dot-com crash in the early 2000s, and the financial crisis of 2007/2008. Therefore, an inverted yield curve is a warning sign that investors should take seriously. For investors, monitoring the yield curve is crucial because it can provide insights into how the economy will develop in the coming months and years. If the yield curve inverts, it could signal an upcoming period of economic weakness, and it would be wise to adjust portfolios accordingly. 4. Historical interest rate cut cycles and their consequences. By examining the history of interest rate cuts by the Fed, we can learn some important lessons. Historically, interest rate cuts have often been a response to periods of economic weakness. While these measures often helped support an immediate recovery, they also had long-term consequences. Take, for example, the late 1970s and early 1980s. The U.S. experienced a period of high inflation triggered by oil crises and expansive fiscal policy. To combat inflation, the Fed, under Paul Volcker, drastically raised interest rates in the early 1980s. This policy led to a deep recession, but also reduced inflation. As the economy slipped into a severe crisis, the Fed began cutting interest rates again in 1981. These cuts helped stabilize the economy, but it took several years for the markets to fully recover. Another example is the dot-com bubble of the late 1990s. Technology stocks soared, and many investors blindly invested in internet companies with unsustainable business models. When the bubble burst in 2000, the Fed aggressively cut interest rates to support the economy. These cuts contributed to economic recovery, but also laid the groundwork for the next major crisis, the financial crisis of 2007/2008. The financial crisis of 2007/2008 was one of the most severe economic crises in recent history. Excessive lending, a massive housing bubble, and complex financial products led to a collapse of global financial markets. The Fed responded with drastic interest rate cuts and unconventional measures such as quantitative easing, where large quantities of government bonds and other securities were purchased to stabilize markets and encourage lending. These measures helped address the crisis, but also led to a prolonged period of extremely low interest rates, influencing many of today's economic challenges. The phases of the market cycle: Euphoria, Accompaniment, and Capitulation. Throughout the various cycles of financial markets, investors often go through a series of psychological phases closely linked to interest rate decisions and the economic environment. These phases can be described as euphoria, accompaniment, and capitulation. The euphoria phase is characterized by excessive optimism and rising asset prices. In this phase, investors often ignore risks and believe that markets will continue to rise. An example of this is the period before the dot-com bubble when tech stocks soared, and many investors believed that traditional valuation metrics had become irrelevant. The accompaniment phase occurs when markets begin to falter, and the first doubts arise. Investors realize that the high valuations may not be justified and start to reconsider their positions. This phase can lead to increased volatility and the first losses. During the financial crisis of 2007/2008, this phase began as housing prices started to fall, and problems in the mortgage market became apparent. The capitulation phase is the final stage where most investors lose hope and panic. Asset prices fall sharply, and many investors sell in panic to avoid further losses. This is often the point where markets reach their lowest point. A classic example of this is the stock market crash of 2008, when stock prices worldwide plummeted and many investors sold off their holdings to exit the market. In the capitulation phase, there is often the greatest risk, but also the greatest opportunities. For long-term investors, this can be a chance to acquire high-quality assets at attractive prices. However, it takes courage and a clear strategy to remain rational during such a time and not share in the general pessimism. If you've enjoyed the video so far, don't forget to like it, subscribe to my channel, and activate the bell to give the channel added value and support my channel for free. 6. Impact of interest rate cuts on different asset classes. Interest rate cuts have far-reaching effects on various asset classes, and understanding this dynamic is crucial for making informed investment decisions. Stocks generally benefit from interest rate cuts, as lower rates reduce borrowing costs for companies and encourage investment. Growth stocks, in particular, which rely heavily on borrowing, can perform exceptionally well in a low-interest rate environment. However, there are risks. In periods where rate cuts indicate a weak economy, corporate profits may come under pressure, which can weigh on stock prices. Bonds react differently to interest rate cuts depending on their maturity and yield. Long-term bonds tend to benefit from falling rates because their fixed interest payments become more attractive compared to the newly offered lower rates. Short-term bonds, on the other hand, offer less potential as they are refinanced more quickly, and the rate changes are already priced in. Real estate is another asset class that can benefit significantly from interest rate cuts. Lower mortgage rates make buying property more affordable, increasing demand and driving prices higher. However, investors should be cautious, as there is also the risk of a bubble forming in certain real estate markets in a low-rate environment. Commodities, especially gold, tend to become attractive during times of low interest rates and economic uncertainty. As rate cuts are often associated with currency devaluation and a loss of purchasing power, investors seek safe havens like gold to protect their wealth. 7. Practical considerations for investors in a low-interest rate environment. In a low-interest rate environment, it's important to think strategically as an investor and prepare for the challenges and opportunities ahead. Diversification is key. A well-diversified portfolio can help minimize risks while benefiting from the advantages of lower interest rates. Consider a broad mix of stocks, bonds, real estate, and possibly alternative investments. Defensive stocks might be particularly attractive in an uncertain economic environment. Companies that generate stable and predictable earnings, such as utilities or consumer goods companies, could provide investors with protection during economic uncertainty. Dividend stocks are also worth considering. In a low-interest rate environment, these stocks not only provide regular income, but often have the potential for capital appreciation as well. Liquidity should also be considered. It may be wise to keep a portion of your portfolio in easily accessible funds to respond quickly to market changes. In times of uncertainty, the ability to act quickly can make all the difference. Long-term perspective. Finally, it's important to maintain a long-term perspective. Rate cuts can cause short-term volatility and uncertainty, but for patient investors focused on fundamentals, they often present excellent buying opportunities. Conclusion: interest rate cuts are a complex tool that brings both opportunities and risks for the economy and financial markets. History shows that rate cuts often follow periods of economic weakness, and that they bring both short-term recoveries and long-term challenges. For investors, understanding the dynamics of the yield curve, historical patterns of rate cuts, and the impact on various asset classes is crucial. By considering these factors and developing a well-thought-out strategy, you can navigate the challenges of a low-interest rate environment while seizing the opportunities that arise. Thank you for taking the time to watch this video. If you want to learn more about the world of economics and investing, don't forget to subscribe to our channel and turn on notifications. We'll see you in the next video.